here to talk about passive versus active. I only have 10 minutes, and clearly I do have a fund specifically that I'd like to recommend. But first I want to go through our reasoning as to why investors should consider active management as a complementary strategy to passive investing. First, to set the scene, many of you will almost certainly be familiar with this concept, but I wanted to place passive, active, and alternatives on a continuum, really. So starting on the left, clearly passive investing products tend to be ETFs in the main, but the key feature is they're attempting to capture the market return. They're not necessarily attempting to beat the market. The advantage is you have access to a number of different asset types, and fees tend to be very low. So clearly they are growing in popularity for that reason. Active funds, which include investment trusts, investment companies, and also open-ended funds that are managed, seek to outperform the market in some way. They also provide access to a number of different asset classes. But the fees, of course, because they're actively managed, will tend to be higher. The manager's aim clearly is to deliver a superior return net of all fees versus the passive product. And then alternatives can be viewed almost as an extreme form of active management, because in alternative funds, the likes of private equity funds, hedge funds, and so on, you're accessing investments that are otherwise very difficult, if not impossible, to gain access to via any other method. Taking private equity as an example, which is what I'm here to talk about, private equity funds typically have a minimum $5 million investment size if you're committing to a private vehicle. And so for most of us, they're not really a practical proposition for our own portfolios. But an alternative fund that's listed on the stock exchange provides access to that sort of asset. And the idea, of course, is that alternatives, being very actively managed, will outperform even a typical active fund of listed equities. Now, private equity, for those who may not have looked into this in great detail, private equity is simply investing into private companies. It's taking equity stakes in companies that are not listed. And why would you want to do that? Well, the opportunity set in private companies is very much larger than the listed market. It's a fact that in the US, over the last 20 years, the number of listed companies has halved as it becomes less attractive to be listed. It's more expensive for the business, and there's more of a regulatory burden. So private companies are staying private longer, effectively. And that has meant, if you look at companies with revenue of more than $10 million, in the US, there are 40 times as many private companies as there are public. And so that's the opportunity set that private equity is tapping into, which otherwise you would not have access to by any other means. I'm sure this is, again, familiar to some, but the listed market is dominated now by former venture capital-backed businesses. So you have, everyone knows Apple, Google, Microsoft, Amazon. They were originally VC-backed. They're now the 4 largest companies in the world by market capitalization. Facebook is number 6. Facebook is a company that our fund supported very early through the investments that we make. Now, the themes that are being discussed at this event, the likes of digital medicine, which help to extend life. I know Jim Mellon is talking about that at some point today. Artificial intelligence, autonomous vehicles, all of these themes are captured within venture capital funds and, again, within our fund. So it's very difficult to access those opportunities at a truly early stage through the listed markets. You will have opportunities, but the majority of these companies are private, and they're managed by professional venture capital managers. Now, HarbourVest is the manager of the company that I am talking about. So I'll introduce the precise opportunity just in a second, but effectively, the investment you might make into our company is managed by HarbourVest Partners, which is a blue-chip private equity manager in the US, headquartered in Boston, founded in 1982, so more than 35 years experience of investing in this asset class. Started investing in Asia as early as 1984 and still have a strong presence there. We opened an office in 1996 in Hong Kong. So HarbourVest provides true global exposure. So private companies, not just in the US, but private companies all over the world are accessed via our manager. And then HarbourVest Global Private Equity is the name of the company I'm here to discuss. So to recap, this is an alternatives active fund, effectively specializing in private equity, specializing in private company investing. What do you need to know? This slide tells you, effectively in a nutshell, the key points that I'm here to make. So HVP is an investment company. It's listed on the London Stock Exchange. It's a component of the FTSE 250 index, so a market capitalization of just over £1 billion. It's a very liquid and easily accessible product. We have around £500,000 a day of trading on the market. What we're doing is providing a ready-made private equity program. So buying a share in HVPE gives you a stake in ultimately 7,000, actually more than 7,000 private companies. So those companies are actively managed by the underlying private equity managers. And when I say actively managed, they are in many cases owned by the manager. So the manager will evaluate the board and make changes to the senior management in the company and drive growth over a period of several years. We have now a 10-year track record. So we were IPO'd in 2007. So clearly not the best year to start off in terms of the performance track record, but I'll come on to that in a second. If you'd invested £1,000 in December 2007 at our IPO, bear in mind that was a high point in valuations, clearly just before the crisis hit. Today, your investment will be worth 2,500. So that's from a high point to today, 2.5 times money in sterling for the shares. And that represents a 10% annual growth rate net of all fees. Now, how does it work? I won't spend too long on this. It is a fairly complex structure. It needs to be because we're providing access to so many private companies, and clearly they're not traded actively, so you need to have various fund structures to access them. But we invest into HarbourVest funds across 3 main strategies. Primary, where we're committing to newly formed partnerships as they're raised. Those partnerships then invest in companies directly. Secondaries, where we're buying established fund stakes on the private secondary market, and we're trying to drive value from those portfolios. So we're buying existing portfolios and then running them for value growth. And then what we call direct co-investing funds, where HarbourVest is raising a fund to invest directly in operating companies with no middleman in between, effectively. So ultimately, to keep it simple, HVP is providing access to, at the bottom level, 7,600 private companies. The results here, you can see from our first annual report in January 2008 up to the most recent estimate in terms of our NAV per share. So this is the value of the assets divided by the number of shares. We started off at $10 at the IPO, grew to $10.39 as of the first reporting date. You can see the impact of the crisis. The bars are showing the asset value per share, and the line is showing the share price. So you can see that what happened was the NAV declined. Since then, it's recovered very strongly. Every year, we've delivered NAV growth. The shares, however, have not kept up with that because sentiment in the market has been affected by the crisis. So this is a sector that it's somewhat unloved by investors. Listed private equity in London, there are 20 companies. We are the 3rd largest, and we're all effectively trying to compete for investor attention with so many other products. And clearly, it's a specialized area. Even within institutional investment teams, there's very limited knowledge of private equity and listed private equity in particular. So there's an opportunity here to buy in at an 18% discount to the asset valuation. Now, I'm running out of time, so effectively this is a list of platforms, the standard platforms you all know, through which you can invest. The minimum investment is £12, the price of 1 share. Our largest shareholder has £130 million. So there's a very broad range of investors that are already in this fund. It's very encouraging for me personally and for the sector, so thank you very much for listening to me. I'm on stand 76. There's a lot more information I could give if I have more than 10 minutes, so please feel free to come along and chat to us. Okay, thank you.